So there's a crash of epic proportions brewing, and no, it's not in the stock market. Remember, as we say on this channel time and time again, the bond market is much larger than the stock market. Now, I know that the subject of bonds can be a little bit dry. However, if you care about your investments and you care about the economy in the future, I think it would behoove you to listen to some of this information, whether from me or from other sources. So right now, we are on the cusp of the worst bond market crash since the Treaty of Versailles back in 1919. We're actually in unprecedented territory here, as long-term treasury bonds 20 years and up are down almost 50%, much more than the S&P 500 and the Nasdaq. We've never seen the bond market crash more than the stock market during a bear market. This is an unprecedented moment. This is why in the biggest bond markets in the world, UK and Japan as an example, we are seeing emergency bond buying happening, and there are rumblings of this now hitting the shores of the US bond market. Now, this couldn't come at a worse time. Why? Obviously, we are on the brink of the worst recessionary period in 40 years. Globally, not just in the US. And one of the ways that the Fed has to fight this is by letting treasuries run off of the balance sheet. Now, when the pandemic hit and shortly thereafter, the Fed was the largest purchaser of treasuries because what they were trying to do was put liquidity into the market by buying up treasuries from banks and governments. And they stored those treasuries and assets on their balance sheet. But now that we've hit the highest inflation that we've seen in 40 years, the Fed has to remove liquidity from the economy. And one way that they are trying to do this is not only by raising the interest rates, which we'll get to in a second, but by letting assets and treasuries run off of the balance sheet. Now, here's the major problem: quantitative easing, which is the purchasing of assets by the Fed, and quantitative tightening, which is selling or letting assets run off of the Fed's balance sheet. These are relatively new tools that were only introduced in the aftermath of the great financial crisis of 2008. The Fed was desperate and needed another tool besides the federal funds rate, hiking or decreasing the federal funds rate according to the monetary policy they were trying to implement. And so they started experimenting with quantitative easing. Now, unfortunately, when we take a look at the Fed's balance sheet here, the Fed didn't really make any serious attempts after the economy recovered after 2008 in order to sell those assets off of the balance sheet. And nobody could see a world pandemic coming. So when the pandemic hit, the Fed doubled their balance sheet. We went from $4 trillion to almost $9 trillion, more than doubled the balance sheet, in order to inject liquidity into the economy when the entire world was at a standstill. This is the danger of running an over-leveraged system, is that when black swan events hit, like the pandemic, then you are already starting from a bad place instead of acting responsibly and selling those assets off of the balance sheet after a major event like the 2008 financial crisis, which thankfully we survived that. But there was no serious attempt at fixing monetary policy thereafter because the economy and the stock market were addicted to an easy Fed, which is why we had an 11-year bull market, unprecedented. And not only is the Fed's balance sheet bloated, but let's take a look at the US national debt. We currently sit at $31 trillion. Now, how is this debt accumulated? Well, it goes back to what the essence of a treasury is. Treasuries are just loans that the US government takes on in exchange for your dollars. And in return, they promise to pay you a higher rate at some point in the future. And because these treasuries and securities are backed by the full faith and credit of the US, they are used as collateral. Essentially, US dollars, instead of being pegged to gold, are now backed by these pieces of paper, these promissory notes that promise to pay whoever holds them back a greater amount in a future time. So they are used as collateral, allowing the entire financial system of the United States and thereby globally to be over leveraged by these treasuries. Whether these treasuries are sitting on the Fed's balance sheet or whether they are used as collateral in the repo market, which we'll discuss. But essentially what you need to know is if the bond market does not function, then no other market functions. Meaning if there is no liquidity in the bond market, the entire financial system might as well just collapse. This is why you are seeing emergency bond buying in Japan after the Japan bond market sets a record for no trades. We also saw the Bank of England recently intervene and continue its bond buying program after they said they would only do so for 3 days. Well, now they're doing it indefinitely. So as the US government continues to issue treasuries in order to pay for its programs, as the Fed continues to roll off assets off of the balance sheet, buyers are just not buying up treasuries fast enough, and this is causing yields to surge. The 10-year yield hit a high since 2008, currently sitting at around 4.2, and it hit a high of 4.33 just last week as of the time of this recording. Mind you, less than 3 months ago, this was trading at 2.5%. So in short, nobody is buying bonds, and this is now worrying the US government, especially after we saw what was uncovered in the UK. And now the US Treasury is asking major banks if they should buy back bonds in order to improve liquidity. Because remember, if liquidity stops in the bond market, the whole financial system breaks. This is why I think the Fed is actually closer to a pivot or a pause of some sort, whether this is pausing quantitative tightening, meaning the rolling off and selling of assets off of the Fed's balance sheet, whether it's a pause in hiking rates. There is something that they're going to have to do in order to stop these rapidly rising yields, and we'll talk about why rapidly rising yields are a problem and what exactly can break in the system. But when a risk-off asset like a US Treasury, the most secure asset known to the world today, when there are a lack of buyers there, you know that there's either a major loss of confidence in the financial system and or there's a complete supply glut of treasuries hitting the market, and there is too little cash chasing those treasuries. All right, so now let's talk about what exactly is the issue with illiquidity in the bond market, what could actually break and what it affects. Number one, and most importantly, when there is a lack of demand for treasuries, yields rapidly rise. Now, it was expected that yields would rise as the Fed was hiking rates and rolling assets off the balance sheet, but not at this pace. It's the rate of increase that is worrying the folks in the government as well as corporations. Rapidly rising yields sets the tone for all commercial rates, money market rates, and interest rates in general. So this means the cost of everything goes up, from buying a house to buying a car to financing debt to grow your business to starting businesses. Also, rapidly rising yields makes it more expensive for businesses to operate, meaning that they will likely pass those costs on to the consumer very rapidly. Also, rapidly rising yields means that there might be a spike in unemployment that is too sudden, as now the cost of doing business goes up, and that will leave less money for corporations to hire. The number two problem with rapidly rising yields is that stocks get obliterated. They get obliterated for two reasons. One, future cash flows are discounted a lot more heavily. See, in a discounted cash flow model, future cash flows are discounted by the risk-free rate, which is usually something like the 10-year benchmark. And if the 10-year rapidly rises like it is now, then that means that future cash flows are more heavily discounted, meaning that stocks are actually valuated less. Also, rapidly rising yields eventually means that investors will be more compelled to invest in treasuries over stocks, so that takes money out of the stock market as well. Number three, illiquidity in the bond market causes fundamental structures in the financial system to break. Let's just take a look at the repo market as an example. The repo market stands for the repurchase agreement market. Now, in short and very simplistic terms, this means when banks borrow from each other overnight. See, banks obviously have a different number of transactions, debits and credits all day, meaning that different people are spending from their bank and also depositing in their bank at different rates all day. So Bank A might have more cash reserves than Bank B. And when Bank B needs to borrow some cash in order to satisfy reserve requirements, they then ask for that cash from Bank A, but obviously they have to hand them some collateral in order to borrow that money. So what do they give Bank A? They give Bank A treasuries. And Bank A then supplies them with cash for them to meet their overnight reserve requirements. However, when nobody is buying treasuries and a mass amount of treasuries is hitting the market, and now you have an overflooding of treasuries, banks might feel compelled then to hold on to their reserves, since now cash is more in demand than treasuries are. They might feel more compelled to hold on to those reserves than lending it out to the other banks. And this illiquidity can cause repo rates, overnight repo rates, to spike. We actually saw this in 2019, and this was exactly due to too many treasuries hitting the market. This was before the pandemic, when the Fed was trying to taper. And this is just one example of something in the financial system that can cause utter havoc across the board. And this naturally leads us to number four, hidden leveraged risk, something we saw in the UK very recently, which could completely wipe out a financial market. What was going on in the UK was that that pension funds were actually investing in leveraged bond derivatives. Now, without going into too much detail, these were basically derivatives of bonds that were over leveraged. And in a normal market, these things are not uncovered as risk potentials because everything is functioning smoothly. However, when bond yields spike because a lack of demand for bonds, then these leveraged derivatives actually go haywire, and these pensions started getting margin called because these were leveraged derivatives. So the UK had to swoop in and start buying bonds in order to drop the rates because there was a lack of liquidity in the market. And again, this is just one example of something that can break in a completely over leveraged system, which is over leveraged almost at every single facet of the financial market in the same way that we are here in the US. And as you know, hidden leveraged risk, like we saw with mortgage-backed securities in 2008, that was a risk that really nobody saw except for Michael Burry and a couple of other people. But the 2008 Great Financial Crisis uncovered what was under the hood, which was over-leveraged in mortgage-backed securities. The number 5 risk of an illiquid bond market is government interest payments. Remember, treasuries are just loans that the government issues in order to borrow your money. When yields are rapidly rising, that means that government interest payments are now increasing. And with $31 trillion of debt, an unprecedented amount, imagine what those interest payments look like, especially with rapidly rising yields. And number 6 is a complete loss of confidence in the financial markets. When yields are rising rapidly and they are out of control and there are no buyers, well, that's going to cause herd mentality across the financial markets, and investors will be less likely to buy because nobody else is buying them, thereby increasing the fear of investing in a financial market, thereby increasing the rates even more. This is why this is leading some people to believe, including me, that there's going to be some sort of pause or pivot very soon. And we just recently saw the president of the Federal Reserve Bank of San Francisco come out and say that the Fed actually needs to slow down. And this is also part of the reason why people like Jeremy Siegel, who is a Wharton professor, has gone on TV quite a few times now, begging that the Fed actually stop or slow down here. Not because he wants easy monetary policy. He just knows that what the Fed is doing right now is reckless, and the increasing illiquidity in the bond market is way more dangerous than what's going on in the stock market. And this is what the crux of the problem is in an over-leveraged financial system, is that if the Fed actually pauses or pivots or does some kind of pullback, the markets will rally again because the markets are addicted to easy monetary policy. And not only that, but we could actually get a rise in inflation once again. This is why back in the 80s, Paul Volcker ripped the band-aid off and raised the federal funds rate to 20%, knowing it will break the economy. But it was controversial at the time. In his mind, this was the only way to get a real reset of the financial system. But with $300 trillion in global debt, with $31 trillion of debt, of US national debt, with $9 trillion of treasuries on the Fed's balance sheet, I don't think that the world can actually sustain a bond market crash. Now, aside from bond yields actually looking attractive as an investment here, if you're looking to trade this volatility, we are seeing an increasing number of trades in the 10-year futures. There are futures based on the 10-year note, and there's an increasing number of bets that look like institutional bets speculating that the 10-year note will actually increase, not the yield, but the price, meaning the yield will tank, will actually increase by November or December because of a Fed pivot or a Fed pause, or because of an emergency bond buying program like the ones implemented in the UK and Japan. We are seeing an increasing number of those bets. So personally, I might be trading futures on the 10-year note. There's also a potential play that I like less, buying calls on TLT, for instance. Obviously, you have to agree with this thesis. If you don't, then there's no business doing any of this. But at the moment, these are low-cost trades and might look enticing as a contrarian trade here. And if the Fed actually slows down, pivots, pauses, whatever, I do think we see a violent stock market rally in the short term. If you want access to all of my analysis, the private trading group with thousands of traders where we discuss trades all day, every day, my trade ideas regarding short-term binary events and long-term, as well as the group monthly Zoom calls and the trading courses. Link is in the description below. Click the link, make an appointment with one of our ambassadors. We'll be happy to have you. And as always, the goal of this channel is to keep you updated with the most important up-to-date market information. Leave a comment down below. Let me know if you have any questions. I try to respond to every single comment. Let me know your thoughts. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.